Let's bring in Matt Miskin, Co-Chief Investment Strategist at John Hancock Investment Management. And Matt, so how are you reading all of this ahead of the Fed? Do you think that any opportunities have been surfaced by the recent upheaval in the markets, or is it a warning sign?
We're leaning into the quality factor, and it's funny that Cameron just brought up balance sheets. That's exactly what we're talking about as well. We believe right now you really need to start any stock screen, any part of the market you want to look at, you've got to start with balance sheet analysis. And the quality factor, we believe, on a relative basis is going to be making a comeback over 2023. 2022 was a tough year for it. We think better balance sheet companies, earnings stability, high return on equity is going to be the pockets of opportunity within the market. So any dips like today where you're seeing sell-off in that part of the market, we would actually look at it opportunistically, and we would rotate further into quality as the year goes on.
Matt, you know, depending on how you define it and how you run the factors to get you to that quality bias, it's going to end. You're going to end up with a ton of tech in there, right? I mean, a lot of the biggest NASDAQ stocks have all those attributes you just recited. Is that okay? Is that what you're after? Is it something to be sidestepped?
We actually like technology as a quality part of the market. It is 40% of the MSCI USA Quality Index. 20% is healthcare. Cameron just talking about healthcare. That's another sector we like as well because of that higher quality element, not as expensive as other parts of the market, and it's more defensive. So we like more defensive parts of the market combined with quality. We are okay with large cap tech. We think those balance sheets are strong, the margins are strong, and we prefer that relative to other cyclical parts of the market, which we think are going to be weighed on more as growth decelerates over the course of the year.
So growth decelerating, if that's what it is, not terrible. Really growth falling away in a big manner and getting us into some kind of harder recession is probably something that's not priced in, certainly, to earnings estimates. Is that your expectation, Matt?
Yeah, so what you're seeing right now, I mean, earnings estimates have come down a smidge, but frankly, the places that have the highest earnings growth estimates for 2023 are financials, industrials, and consumer discretionary. And we do think those are too high. We don't think consumer discretionary can do 20% earnings growth this year, but that's what the street is looking for. Earnings growth estimates in technology aren't that high, frankly. They're low single digits. So we actually see some of the cyclicals, and Cameron was also talking about this, that's a cyclical love that was happening to start this year, we actually think is going to fade over the course of the year, and you can see this rotation. Now, overall, Mike, it's going to be tough. We do think this market is going to be a challenging one. We are leaning a bit more into bonds versus stocks, but in the equity part of the portfolio, we're seeing these opportunities in higher quality assets that have been on sale last year, and that's where we think this relative opportunity exists today.